Hello and welcome to FinTech Diary. Every week, we speak to an industry expert who's part of the FinTech revolution. In the world of FinTechs, which is based on constant evolution and innovation, we question change makers. How do they plan ahead and read the future developments? The focus of the FinTech Diary is to get the breadth and depth of every segment related to FinTech in every chapter. My name is Amol Dete, and my guest for this chapter is Mr. Raman Kumar, founder and CEO of CASHe. Raman, glad to have you.
Thank you, Amol. Thank you so much.
Thank you. So, Raman, to begin with, since you are into the lending space, I would like to learn from you why every fintech or everyone is getting into the lending business now.
Great minds think alike. So that's one explanation I can say. But otherwise, it's an untapped market. India is a credit underpenetrated market, and that's one of the major reasons. If you look into any calculations of penetration of credit cards, usage of debit cards, number of people who are in the credit bureau scores, number of people who are in the prime and who actually are the others who are not covered within the bureau reports. So there's an untapped opportunity in an economy like India, where people, unlike in investment economies where school loans, college loans start the whole credit rating system. Whereas when kids come, when they're millennials, Gen Z millennials, at the age of 21, 22, come with absolutely no credit history at all. That doesn't mean they're not credit worthy, but that just the way in which the entire business has progressed in India and grown in India. So that's really where I guess people think that there is this huge opportunity for credit lending, especially digital, with everything that's happened in the digital tech stack. This was a natural consequence.
Okay, noted your points, Raman. We'll take a couple of more questions here while we go ahead for another 20-25 minutes. But to begin with, Raman, I would like you to also tell us or tell our audience specifically about how many loans are you disbursing on a monthly basis? What is your market size right now? How long have you been operating in this space? How has been your experience specifically in terms of lending? If you could share some data points, that would be really.
Yeah, so we as of now, we just came out of March. We did about 200 crores of lending in the month of March alone. So on a run rate basis, we are doing about 2,400 crores. And we actually came coming out of the entire COVID sometime around July, August, we started to normalize. But it was around September, October that business started to pick up. And then we had this little scare of COVID-3 towards December, January. But that really didn't impact that much. But we had a good January, February, and March was a record month for, I think, not just us, but all of us in this business. So that's about roughly, we give about 1,500 to 2,000 loans a day. So on a 30-day, you can look at the numbers that we're talking about.
Any average ticket size you have?
Yes, but again, the number of products that have diversified over the last 6 months. So if I take just the personal loan, that number is in the region of about 45,000 rupees, which is the average loan size. But it goes from 10,000 up to 3 lakhs. But that's where it sits on an average basis.
Okay, noted your point. So the important question, when you look at the loan is obviously it can be divided into two parts, secured and unsecured. Since most of your loans are, catering to the unsecured portfolios or unsecured segment, immediate question I have, Raman, is, and maybe you could explain more, is how do you actually analyze the risk of this whole unsecured loans?
Amol, I wouldn't have started this business if it didn't have that secret sauce of being able to foretell whether we're giving the money to the right persons, and whether when we give the money, whether the money is going to come back to us. Those are the two important questions we try to resolve using our algorithms. So our big issue of starting this business was, do we have the right algorithm? So starting in 2016, when we started to create the algorithm, the first algorithm is called a social behavior filter, which is an original algorithm. And then we have a goodness measure, which is the second algorithm that we use. Combined together, we form the crux of that SLQ, which is the social load quotient, which is our alternate credit rating number or score. And that's really decides whether we give a loan or not give a loan to a person. And so we've been, over the last 2-3 years, for instance, while the machines have learned much more with more people coming into the system, they started to throw exceedingly good results, and that's reflected in A, the number of loans that we're giving, and B is the number of bad debts and the amount, the value of bad debts that we actually have, which is as good or as bad as secured lending. So that's a major proof that the algorithms are working, the machines are working well, they're learning well, and we are able to grow the business.
So, how has been, delinquency specifically? Because you created or maybe you crafted two different algorithms, to mitigate the risk really well. But did it by any chance, what you can say, put you in trap? Were there any chances that customers did not pay at all? Were there any repayment issues? Because ultimately, algorithms are algorithms. Human mind is a different, ball game altogether. So what kind of NPAs did you actually see specifically in this loan segment, and how did you deal with it?
Yeah. So proof of the pudding, and that's really how our business model worked, was that we wanted to put our money where our mouth was. And so we actually are a lender on record. So we have an NBFC, and most of the lending, except for a very small component in the current year, there's no co-lending book of ours. So we basically lend on our own balance sheet, and obviously we need to account for all the bad debts ourselves. We can't book it in any manner, calling it, whether I call it business development expense, etc. I can't, as an NBFC, can't afford to do that. So effectively, as far as the NBFC is concerned, we need to recognize as per RBI norms, and we are currently a systematically important NBFC. So our audits with RBI are fairly intense. We just had a 3-day audits that happened about a month ago. So the thing about bad debts is the fact that it all depends on how good your underwriting has been, and it's a true reflection of that. And what we have seen that even in the blip period of COVID-1 and COVID-2, our numbers did not dramatically increase. So what used to be around 1.5, 1.75% went up to about 3%, 3.5% during those months. And then they started to taper once again. So we currently are running at about roughly in the region of 2.25% on NPAs. So the way in which the bad debts are recognized in our business is, it's T90 and above, everything is bad debt. As far as we are concerned, we have to provide for that entire lot. But then when you write off at the end of the year, that is the actual write-off that happens, because money still keeps coming in. So what we have seen is that 82 to 83% of the money comes on T+1, which is on the due date, it automatically comes in. And then by the time it hits the T30, we get it to about roughly 90%. And then from T30 to T90 is the effort that needs to go in order to bring the rest of the money in. And we basically are able to touch that 96, 97% by the time we hit that 90 days. So, but still money still trickles in, because all these people are young kids who have, like as we said, goodness measured is about intention to pay. So most of the algorithms are good enough for us to create that confidence, but there are always people who get into an exigency and an emergency. They can't pay, or they just don't want to pay. Some people, despite all the algorithms I use, some people still want to game the system, and that percentage is always going to be there in any business. And that's really where we talk about that 2.5%, 3%.
Okay, noted, Raman. So do you think your strategy, specifically of challenging conventional banks, that's how you started your business maybe 8 years back. So Is your strategy, which was specifically challenging the conventional models or traditional banks, has proven right by now? Because I think 8 years is a fair time to maybe judge that what you're doing is absolutely right. The one I think safer bet that you have done is you have always lend it to or lent to the people those who are from the salaried class, right? Something like that. So one question, Raman, here is specifically, how has been your, I mean, how do you think your strategy has been in last year, whether it's proven right in last 8 years? And will you continue the same strategy going ahead, or maybe tweak it or add some different layers?
Yeah, so part of our underwriting smarts is also to deal with the fact that the millennials that we are dealing with are are salaried. We don't have algorithms right now that can predict the reasonable behavior of self-employed or what we call as the rural and the lower urban blue collar. We're not able to actually predict because we don't have enough data on that. But when we have the right data and we are able to predict with reasonable accuracy, we will expand the business. But right now, the millennial cohort that we are dealing with, which is primarily the service sector of India, and they start right from 21, 22 with all the services businesses that are out there, and that is a fairly large sector, and we really need to first crack that market and have market share which is worthwhile. So that's really is our first step, and we want to be doing the full gamut of what we call the wellness platform, a financial wellness platform for the Gen Zs and the millennials who are salaried, and that's really is the focus that we are currently working on.
Okay. So what kind of growth? One is again, will you again expand your horizon apart from the salaried class, and maybe offer personal loans specifically to your non-salaried class as well going ahead? And also, are there any observations specifically in the lending space where the millennials or Gen Zs, borrowing really high, in last couple of months or quarters, because there has been various reports which suggest that millennials and Gen Zs are borrowing really high. So what has been your experience on that front, Raman? Two parts.
This is it's a kid in a candy store. So obviously, when there is more credit available, people will avail of credit, and then they are at the same time, when you look into the e-commerce space and everything else that's happening in the digital space of commerce, yeah, you actually see that there's a lot more that's available as choice to buy and purchase, whether it's smartphones or whether it's dresses to clothes to shoes to everything else. And this is percolating right down, like a Misho is going down to the number three, grade 3 towns and grade 4 towns and into the rural sector. So this is an all-permeating thing. I mean, economies prosper because there's credit. Now, there is no right or wrong thing about what is the right credit. We ourselves put riders on it. So what we tend to do, and that's really one of the reasons why salary becomes an important component, is because we don't want indebtedness to go beyond 30 to 35% of the salary, because we have to leave enough for the gentleman to survive, make a living, and we don't want him to be 100% plus leverage. So we make sure that the riders, the monitors that we put into our system, make sure that the credit is never given beyond 35% of his total salary.
Yeah, sure. I think that's a very important filter that you have added, Raman. But I'm actually trying to understand. At one side, it sounds really good that India is a credit-hungry country, and a lot of people are, specifically like you or maybe other fintechs, are trying to cater to that need. But like the example that gave, the kid in the candy store, right? This is what is happening, because I think people are borrowing left, right, and center. Maybe you will have a 35% of cap, but that person is borrowing from different players as well, right? So ultimately, don't you think in somewhere, since a lot of players are kind of disbursing funds to all these kids in the candy store like never before, if he eats so much chocolates, maybe he will be, what you can say, uh, maybe he will be exposed to diabetes very soon. So same way, maybe he will exposed to a bad credit and bad defaulter very soon. So how do you, I know I put too many thoughts together. There is no direct question here. But Raman, don't you think, that we are perhaps doing it too much with the credit and, just trying to offer so much to the millennials and Gen Z and trying to, make them buy what they want to, perhaps which they don't need?
The underwriting as well as ultimately the loan giving activity also gives us a responsibility to go check his trade lines on his bureau. Though I'm not using the bureau score for any analysis on him, but what we actually see visually is the trade lines, that how much he's borrowed, what are his payments, what are his installments. Everything is available in our system. The second thing that happens is we also, have a one-time access to his bank account, primarily because we have a mandate that we actually pull from the bank, and so we actually do an analysis of the bank. The whole portfolios analysis is done because we get access to their bank account. And we know in the bank account how much money is he having, how much saving does he have. So there is a whole bunch of stuff that's going behind that credit decisioning. Which actually takes care of some of the stuff that you just mentioned, which is, is he borrowing from too many places? Is he borrowing from one person and paying off another loan? All that is actually available to us. So now, as a good lender, we need to make sure that we put all these in his credit rating system. So when I am actually underwriting somebody from CASHe point of view, we basically take all that into consideration. Although for us, a typical banking standard like a FOIR is not applicable because these are short-term loans, but we do have that if he's got borrowed money from a short-term lender like us, and also at the same time he's got two concurrent loans coming from two other short-term lenders, well, our antennae are up, the scores go lower, he will not qualify for the loan. I mean, there are a whole bunch of things that happen in the system in the background. So yes, we take all the precautions, because if we give loans indiscriminately, our bottom line, and remember, it's our money. We need to get back the money, and I'm answerable to my shareholders and my lenders. So we just can't afford to write off things. So from a conventional NBFC to the new fintech, we have no excuses to make bad decisions. It just, I can't explain away a bad decision. I mean, I've got all the tools in front of me. They are available to me. And if I'm still having bad debts, which are like, frighteningly bad, like, conventional banks have had in the past, that's because they just didn't have information or didn't want to have information. So, both those things are not relevant for us.
Sure. So one more quick question here, Raman, since you have large number of customers and maybe disbursing, like you said, more than 1,500 loans per day. How many repeat customers do you have? Have you checked that data by any chance?
Sure. I mean, this is, in any case, we are a big data analytical provider for ourselves. So more than 60% of our customers are repeat loan customers. And that's also because every month when we are bringing in customers, almost we are adding about 40 to 45% new customers, and then we have 60% of repeat customers.
Okay, so that's quite interesting, Raman, if you're adding more than 40-45% new customers. So another question that I have is, most of the NBFCs or fintech players are also charging heavily, specifically because the loans are, maybe a small value, the ticket loans are small, and also the, it's a tenure is also a very small, in that way. So what makes you confident on these loans? That is one specific in terms of that. How are you making a sustainable business, and how are you charging more interest, on this? So if you could, put my, what you can say, things right. The question is, how are you making a sustainable business model out of these small loans, and will it be really sustainable going ahead? Because what has also happened is a lot of fintechs have also been offering the same kind of loans and offering the same kind of algorithms and data, and catering to the same kind of customers. Maybe you started 8 years back, so you have a large base and you're known in the market. But how are you going to create a sustainable business with the whole competition coming in the picture?
Yeah, Amol, that's an important question. Interest rates are based on the risk reward. that we really need to evaluate. So if we are looking into a customer who is new to credit, or he's subprime, then automatically the risk of actually lending money to that person and his opportunity to go borrow money from anywhere else is also very low. So for us, we had to charge that extra price because the chances of he reneging on the loan are also higher because he just doesn't have a history. And we are taking that risk, and that risk needs to be rewarded. So what we've done is our maximum marginal rate that we charge is never more than a credit card overdraft. So we do not have any interest rate which is over and above what a credit card overdraft is. So that I don't think is a usurious, because credit cards are only given to prime customers. In fact, across the board, whether it's MasterCard, Visa, or Amex, they don't do any credit cards are given for less than 700, 720. In fact, 720 is the average credit rating for them. So given 20 people are actually availing loans at these prices, we are now talking about somebody who's new to credit, who's got 600 score or he's got 500 score, and he comes into, when we evaluate him on alternate data, if he comes across as credit worthy, well, the maximum rate that we are charging is only that much. So and RBI is very strict about it when especially it comes to NBFCs. So they basically tell us, look, your APRs at any given point should not exceed a threshold. For them, that threshold in their own calculation is around the 45-50% range, because and beyond that, they wrap everybody on the knuckles. So we can't just afford to do the stuff that normally people that you've read before, that people have been able to do. Most of the Chinese apps and some of the more more clever app lenders who have who charge a very high processing fee and then charge on a daily basis. All that stuff is now history. Government is very, very strict about monitoring this. RBI is very strict. NBFCs are monitored once you become an important NBFC. So I think there are precautions that the government has already taken. But still, look, there are always people who are extremely needy and who will go to some of these really blade companies that charge usurious rates. But I don't think that's a model that will survive.
Can you add, some more insights here, Raman? Because this is a burning topic right now. And in fact, the RBI itself has showcased its displeasure against these Chinese apps, and they are also taking a lot of actions. But since you're into the lending space since really long, and specifically digital lending space, what do you think is going wrong? Because people are, like you said, kid in a candy store. I like that, the phrase. People are going really heavy when they are getting the credit easily, but they do not know the catch involved into it, because of most of the apps don't disclose that information. And then they start blackmailing this customer specifically on a social media or their contacts or something like that. So what's actually the modus operandi here, or what's going wrong here in the specific digital lending side?
I think it's if you go back to it, it's obviously the consumer culture which actually allows there's a lot more use cases where to borrow money, and so this is the entire economy as it's emerging and evolving. Now the only question would be, regulations need to keep pace with these changes, and unless there are regulations, and it's and in any case, if lending and financial sector is a highly regulated sector, so we just can't afford to have licenses given left, right, and center. And one of the things that people were trying to do for gaming the system was using an NBFC of somebody, and then the apps were just being put in over there and control the NBFC by the app. I mean, that was typically what was happening with the Chinese apps. They never really got the NBFC licenses, but they were using off-the-shelf NBFCs, and they were funding them, and then basically creating this whole what I call environment for clever lending. But I think government is woken up to that, and I think there are enough there's enough happening out in the market where some of the stuff is emerging, and the government is taking quick action on this. But as far as any lender is concerned, what happens with all of us is that moment we lend to somebody who's not financially savvy and financially responsible, while taking money, you sign off everything, but when you have the time to return the money, then that's when the pain starts. And then obviously, some of the complaints that you actually see on social media, some are fair, some are really unfair, some have they had no inclination to pay, they just wanted to game the system. So you're always caught in the crossfire. So you need to figure out what is the truth and what is an excess. And we have, as a rule in the company, what we have is a redressal system. We actually make sure that the entire senior management reviews all the complaints on a daily basis. And we see if there are genuine complaints where people really have a problem of paying and they actually gone into a serious problem. But we need to evaluate each and every instance. If we don't do that, people can come back and say, look, my mom had an eye surgery, my father was in the hospital. I mean, there are things that anybody can say. Now we need to obviously sit down with the person and verify, really, has he gone through some of those problems, and then can we reset the loan. Good thing about all this is this falls within that 3%, 3.5%. We really, this is not the norm. These are the exception management that we need to do. So, and we do this on a constant daily basis. And so as far as the company is concerned, we ourselves have evolved in the sense that we realize that, look, by being a pure fintech, when we start to lend and the balance sheet is expanding, we really needed people who have done retail lending and who've actually been there, done that for large banks, need to come on board and help us and help the younger team, which is on the tech side, to be able to underwrite and collect. And that's what we really have done, where we've hired some seriously senior bankers in the company, and they've now come over to oversee the expansion of the business. So obviously we need to be a responsible lender, and we need to be absolutely sincere about the way in which we go around collecting as well as treating our customers.
Sure, Raman. Let me shoot one more question, and that's the last question. We partly discussed the competition part, but let me take that question forward again. So, like I said, sometime back, and every fintech today wants to go aggressively into the lending space. Banks are also geared up to lend digitally. In fact, I was talking to a PSU banker, and he says, I want to automate my, all my loans, specifically on corporate loans, with a minimum cap of, 30 crore or something, towards a digital side. So everybody is going aggressive on the digital side. So how this competition is going to emerge, and what next specifically for CASHe? Because now we have been in the market for 8 years. We have actually understood the market really well. And there are also theories, somewhere that most of the experts believe that, the NBFCs, for the better future of the NBFCs is to merge with some, bank going ahead. I mean, this is a talk, and many people carry this view. So by any chance, do you think about one IPO? Because that's one thing that all the fintechs are thinking of right now. So one, are you looking at that side? Second, will you look for some maybe digital banking initiatives or something like that? So two things, Raman. One, how the competition will emerge, and second, what are your plans, or what is the future of CASHe?
And I think my answer to all of them is an affirmative yes, but let me expand on that. So as far as banks are concerned, banks are natural partners. The only thing about banks is that their compliance will not allow for high risk lending, and especially in the unsecured space. And that's one of the big issues. Second one is also the fact that if you do not have a bank account within that bank, in order to lend to somebody who's got a bank account elsewhere, becomes a bit of an issue as far as a bank is concerned for their own underwriting and for their own compliance. So while fintech companies can attach themselves to a bank, they're still restrained by the fact that they still have to do an FLDG kind of a business where they write the first loss and bring these what the banks would consider as risky customers into the mix. And that's what is being explored right now. But an FLDG is only a small portion of this business. Ultimately, for banks to expand, they need to cover a larger segment of population. And for that, their underwriting processes and their compliance processes need to be changed. And I think that's not happened so far. So until that happens, banks will be partners, but competition for businesses like ours will be much more remote. The second question, second answer to the problem that you raised was about, how are we going to, look at competition? What's the innovations that we do? So if you look into what we are doing currently, Amol, is the fact that we are not just a personal lending company. We have a credit line where it's money on tap. You don't have to take the money now. You can take the money whenever you want. So it's almost like a quasi credit card, except that it is on your app. The third one that we've done is the whole on-the-fly BNPL. In fact, we are the only ones in the country right now. We do a BNPL, a buy now, pay later, on the fly at checkout. If you're not a customer of mine and you still want to do a BNPL and there's nobody else willing to give you a BNPL, we are there and we evaluate you within seconds. So effectively, you just have to give me your name and your salary and where you're working. Those are the only three things I require. All the underwriting happens in the background within seconds. And we actually then give you on the fly a BNPL for when you're about to complete a purchase. So that's a product which is not, nobody else has got on the fly. You have to be a customer first with us or with some of those lenders in order to get the BNPL benefit. And the fourth one that we are doing, and I'm just going to announce it in the next 10 days, we are about to finalize, and I think day after tomorrow is my board meeting, and after that I can reveal it. But we are buying a wealth tech company, with which we are actually looking into the whole micro investment for the Gen Z and millennials. So one of the important things about our business is I'm not talking about just lending, not talking about spending, but we're now talking about saving. That's being more responsible than most other people in the business, and that's an important aspect of how we would like to grow. So we have InsurTech, we have wealth tech, we have spend tech, and we have lend tech. So those are the four components of our business, which I think makes us different than the rest of the people out there.
For sure, I think we need to thoughts from it, and wish you the best on that journey. And I will, connect with you specifically on that company, which company you're going to buy, how much money you're going to spend on that side. But I think meaningful conversation, Raman, and thank you so much for taking out time and sharing your inputs here.
Thank you, Amol. Thank you so much. Appreciate it.
So that's a wrap, ladies and gentlemen. Click on the FinTech Diary tab to view our previous episodes as well. If you like it, please don't forget to share it on social media. Also, please ensure you have subscribed to our daily newsletter, which is absolutely for free. Thank you so much, ladies and gentlemen, and thank you so much, Raman, for sharing your inputs. Thank you.
Thank you.